Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, September 26th, I believe. Let me double check here. Sorry, I almost lost track. September 27th, excuse me, September 27th. And we'll start off the day with the economic news releases and the weekly jobless comes out every Thursday. So last week there was a reported of 382,000 people applying for unemployment. We figured that number would come down a little bit to maybe 375 range, and it came into 359. So quite an improvement there, about 23,000 jobs, less people applying for unemployment from the previous week, which is obviously good news. Durable goods orders for August came in, and we had 4.1% increase for July, and we figured that number would probably come down to about down to about 5.3, and it came down to 13.2. So not such a good number for the durable goods orders, as we've had a lot more of a slowdown in regards to people ordering items there. And then GDP for Q2, we had 1.7 early revisions, and the estimate for the final revision was at 1.7, and it came in at 1.3. So a lot slower than we originally anticipated or thought we were. It's still some growth, but obviously very slow growth. And not least, or at least finally, finally the pending home sales for index for August that NAR comes out with, and that was 2.4 for up 2.4 for July, and for August it came down 2.6%. So we had fewer homes, pending homes sales for the month of August compared to the previous month. So, so the last obviously three items are not as good. Weekly jobs claims, obviously it's all about jobs. So as you'll see here in a minute, that's what they're kind of rejoicing about, the stock market. So the stock market's up due to jobs. They're also feeling that maybe the reason why the unemployment number came down is that there was more jobs than they originally anticipated. So maybe those people falling off and not looking, still really unemployed, that maybe they actually have jobs. So that's what they're kind of thinking out there right now. So we'll jump over to see the bond market, see what we're looking at here and what interest rates are doing. So we've been having this nice upward rally here, which means improvement in the interest rates. We are currently down a little bit. We closed the day at 105.91 yesterday, so we're down about 13 basis points. But we're up for the day so far, so up about 12. So we're on the lower part of the spectrum of the trading range here. So we're still okay. We can still keep in this range here. Obviously, we just don't want to get too much lower than this, so we could start perhaps a downward trend. So right now the interest rates are not as good as yesterday's, but still pretty good. But I would be very cautious. And even though we're having these, I would be very cautious if you have rates that you're floating. I would definitely try to lock in this week, as many lenders going to be kicking in the new G fees starting next week. That's the government's implemented. It's a new tax that the government's. You probably don't hear about this on the news, but because they say they're not going to tax you, but those who are getting new mortgages are taxed through the use of what they call a G fee. That goes. The last one that came out was back around January or so, when they satisfied that unemployment for last December. They had one kick in for there, and now we're having another one kick in, so they can collect more money. So that's a new tool to be able to collect more money from taxpayers, is by putting into a tax fee. And how that works is that they are basically putting a fee into the pricing of the interest rate, so it's kind of built into the interest rate, and it could affect your interest rate a little bit more. So your cost will go up a little bit. So I would definitely try to lock in this week. Some lenders have already started gradually increasing it, so they don't feel the effects of it as much, rather than one straight hit. But a lot of lenders are going to hit you with a straight hit next week. So even though we may have improvement in the bonds, we'll be offset with the G fees that will be kicking in, and they're going to be in a later faster. So it depends on the scenario for the pricing on that. So, all right, folks, thanks for stopping by. Have a great day, and I will see you guys tomorrow. And if you guys like to have these videos sent to you on a daily basis, just stop by mikesdailymarketreport.com, subscribe, and you'll have these emailed to you on a daily basis. Have a great day.